This session considers the problem of disclosure overload in financial reporting. Chief Finance Officers and Finance Managers nominate the complexity of disclosure as reasons for late or poorly prepared performance. Across the board, they note increased time and effort to prepare them. They note that the audit process drives the additional disclosure. Chief Executives and Director Generals have commented there is nothing like reading a set of financial statements to cure insomnia. So if the leaders of the organisation find their financial statements a challenging read, this view is likely to be shared by other users, such as your minister. Over-disclosing creates a governance risk. The sheer volume of information means important information can lose its prominence and relevance. You can see from this example that the Department of Education and Training financial statements have doubled in size over the last 10 years. I don't think this reflects a doubling of the complexity of the department operations. This is consistent across the Queensland public sector. It's been 10 years since Australia adopted international financial reporting standards. IFRS moved us to a rules-based approach to disclosure. The adoption of IFRS is not the only reason disclosures have increased. Fear of criticism from regulators and auditors is another cause. There is also the mindset of preparers of financial statements and auditors of, when in doubt, disclose, or we've got the information, so why not disclose it? We acknowledge that as auditors, we have been guilty in the past of pushing too much disclosure. We are working with our staff to ensure they understand materiality and do not insist you slavishly follow model financial statements. A number of Australian and international reviews have been undertaken recently, and all have called for the rationalisation of disclosures, and all have identified a risk that quantity is outweighing quality. Our focus this year is to work with the finance teams to assess your disclosures and eliminate from the pages the noise, the waffle, the meaningless definitions, and to leave behind only the financial information that is important to users. To help us, we need you to consider this question when you prepare the 2015 financial statements. Decluttering will take a lot of your time, so why do it? Well, the improvement of the governance around financial statement disclosures will have a number of positive impacts on your entity. Less disclosure equals less time taken to complete pro formas and the final product. Less time on financial statements is time that can be spent elsewhere in the finance function. There is a cost associated with clutter, the time of yourself and your staff in updating and preparing supporting work papers and reviewing them, and the time of audit in checking them. And probably the most important reason is that a shared understanding of materiality between the finance team, the CFO, and those charged with governance, such as the CEO and Audit Committee, will help identify the areas of importance to the users. Public sector entities are mandated to use Sunshine Department model financial statements as a guide. Queensland Treasury updates these annually and provides guidance on use and application. The benefit of applying a standardised pro forma like Sunshine is consistency in style, and it allows comparability across departments and agencies. But Sunshine is only a guide, and significant tailoring is required to communicate the financial results and risks in a concise, readable format. This is where the overhaul is required. We recommend that you adopt a staged approach to reducing disclosure. In the following slides, I will share some principles about what to consider and also provide some examples that are quick wins. There are many obvious reductions that you can quickly rule a red line through and eliminate. There are also some further reductions you can consider this year. The Key Management Personnel Note and the Financial Instruments Note are two that come to mind. There are three basic questions that you need to ask when reviewing current and potential disclosures. Is it relevant? Relevance is specific to the entity operations. You should not consider any disclosures to be automatic. Information is relevant provided it is entity specific and tailored to meet the needs of users. There is no need to disclose anything that is irrelevant to the entity or anything that doesn't add to the understanding of the operations for the years. Entities do not need to disclose all accounting standard requirements if the disclosure is not considered material. Disclosure should assist the user in their understanding of the conditions reflected in the performance statements, cash flows, and any future financial risks. Reassess relevance annually. Is it material? Information is considered material if omitting it or misstating it could influence the decisions of the users. Materiality guidance is provided in AASB 1031. It is no longer prescriptive. The former references to percentages have been removed, and there is an emphasis on risk-based qualitative and quantitative factors. Management must use professional judgment when defining what is material. Be prepared to describe how materiality has been arrived at and ensure this is consistent with the risk of the organisation. It's also not just about over-disclosure. Consider under-disclosure. Ask yourself, if the information is not included, would the financial statements mislead users? Please engage with your auditors throughout the year to discuss material disclosures, transactions, and implications on the financial statements. Clarity is important. Your financial statements are how you communicate what matters to the users. Use plain language and remove technical accounting jargon. Reconsider the layout to give prominence to the most relevant and important disclosures. Now for some quick wins. For example, new accounting standards. I often see pages of descriptions of new accounting standards that have absolutely no relevance to the entity being audited, now or in the foreseeable future. These pages could be replaced by a single sentence stating they have been considered but do not apply to the entity. Another example I observe is template disclosures, such as leasing. If your entity does not have any finance leases, an accounting policy note concerning finance leases is not required. How often do you see this? No additional information is provided. It's just clutter. It tells you no information about the entity. Clutter obscures. The revised AASB 101 has a new paragraph, 30A, which states, "An entity shall not reduce the understanding of the financial statements by obscuring material information with immaterial information." Now, you may argue that the accounting standard on inventory has disclosure requirements and that this is why the note was included. However, paragraph 31 of that standard states, "An entity need not provide a specific disclosure required by an Australian accounting standard if the information resulting from that disclosure is not material." There is significant duplication in most sets of financial statements. It's not hard to find. In this example, all of the information in Note 13 is also found in the Property, Plant and Equipment reconciliation. On that basis, Note 13 is not required. This is an example of a note that is not material, provides limited value, and could be eliminated. If, for some qualitative reasons, management determined that some disclosure was required, better disclosure would be a single line stating, "The entity has contingent liabilities in respect to legal claims. These amounts are immaterial." But materiality is not always straightforward. The circled notes appear to be immaterial. If they are in fact immaterial balances, they do not need any further disclosure. The note references in this example took you to some minor disaggregation that provided no valuable information. But if the variances related to matters of importance to the business, then by all means disclose. When you make the disclosure, you should consider, does the disclosure add information that increases the user's understanding of the entity's financial position, performance and cash flows? If the balances are further disaggregated, do the additional lines enable further understanding of the key components of the primary financial statements? If the balance exposes the entity to financial risk, are those risks discussed together with management's approach to those risks? If the balance is one where management has exercised professional judgment, is the basis of recognition and measurement disclosed? If the variance relates to items not recognised in the financial statements, such as contingencies or commitments, What is the impact on future cash flows? As I've just said, materiality depends on the size and nature of the item. We believe this is an example of under-disclosure. This note, placed well towards the back of the financial statements, resulted in our office undertaking an investigation and issuing a 71-page report to Parliament. In hindsight, I think the users of the financial statements would have wanted to know more about this transaction. The transaction certainly influenced subsequent economic decisions. We ask that when you undertake the exercise to reduce disclosure, that it is more than just a culling exercise, and that you consider that some disclosures may have a lower materiality threshold, such as write-offs or valuation increments or decrements. Focus on the areas that require your professional judgment. These are changes to accounting policies and the financial implications of them, significant new balances or events, and clearly explain where judgments and estimation have been used and provide enough information to assess those assumptions. This is another example of a smaller department that has disclosures over and above what is necessary. Every entity will be able to get some of the quick wins described above. What about the rest of the notes? From our preliminary review of public sector disclosures, the main notes that are required but can be made far more concise are accounting policies. State only the ones that apply, and don't repeat the requirements of the accounting standards. Tell the reader about how these requirements relate to the entity. A well-worded accounting policy note can eliminate the need for any further disclosure. Key management personnel. Biographies are not necessary. Key management personnel are usually responsible for an element of strategic direction. Simply state that element. Financial instruments. This note often takes up pages of valuable space, but provides very little insight into the financial risks of the entity. If your entity does not borrow, you don't have to comment on interest rate risk. You do not have to include sensitivity analysis if the balance is not material, or if the possible basis point increase is not material. These are the key messages we would like you to take away today. We have already discussed them with audit committees, and they are promoted in the QAO March 2015 publication of Insights. You cannot achieve simplification without having the internal systems and governance structures to enable good month-end or year-end accounting. Create a financial reporting process throughout the year. Undertake detailed planning that includes a review of the controls around the preparation of disclosures. Clearly identify the users of the financial statements. What do they need from the financial statements, and consider how you can meet those needs through disclosure. Set clear materiality objectives up front and before you start on the pro formas. Maintain communication between preparers and auditors. Ensure we both have a common agreement on materiality. In these last few slides, I will recap on last year's presentation on month-end and year-end processes. Timely and accurate financial reporting is essential for effectiveness in decision-making, management of public funds, and public accountability. We report on this annually, and overall we are observing improvements. A key driver of timeliness and quality is the rigour surrounding the financial statement preparation process. We will continue to partner with the finance teams to drive early close, better pro forma drafts, and more effort on the balances that matter. This is consistent with the year-end expectations of the Under-Treasurer, last communicated in writing in January 2014. The Under-Treasurer's expectations are summarised on this slide. These strategies cover key areas including strengthening monthly reporting routines, completing non-current asset valuations and stock takes at interim dates, obtaining early clearance of pro forma financial statements, identifying and resolving accounting issues, preferably before year-end, and using internal audit to check quality. Similar expectations are now mandatory in New South Wales. We assessed the 21 departments for the 2014 year-end. There is still room for improvement, and we will continue to monitor and report on this. Of particular concern to us as auditors is the early and thorough completion of non-current asset valuations and the early identification and resolution of accounting issues. Our auditors will continue to assess adoption of the Under-Treasurer's requirements, specifically focusing on the quality assurance of financial statements supporting work papers. This should be done by appropriately qualified and experienced staff. Non-current asset valuations. Independent revaluations are not required annually, but we need you to make an annual assessment of valuation inputs and impairment. Good quality pro forma statements. They need to be provided to audit by an agreed date, preferably by May. This should be tied into the reduced disclosure. Rigorous analysis of the balances reported in the financial statements. Do they include good explanations to those certifying the statements of the reasons for material variances or apparent anomalies? Our future reports to Parliament will continue to report on the progress being made by the Queensland public sector.